Good morning, everyone. Today we're going to keep reading the next article. So let's open the book. So today, article 25, we're going to read about behavioral finance in algorithmic hypothesis formation. So the first part is about definition. Behavioral finance studies how people make decisions and examines the psychological factors that influence and skew the decision-making process. The traditional economics and financial theory generally assumes that market participants always act rationally by considering all available information in the decision-making process. In reality, financial decision-making is a complex situation. When faced with so much information to constantly process and update, people often don't have the time or ability to come up with a completely optimal decision. Instead, they often take an easier and more subjective approach. They often use only parts of the available information and determine a course of action that best suits their judgment and priorities. They are content with making a sufficiently good choice rather than making an optimal choice. In this way, they may inadvertently bias the investment decision-making process. Behavioral finance does not assume people are always rational. It believes that people are limited in controlling themselves and are influenced by their own biases. These biases are two main groups: cognitive errors and emotional biases. The second part today is about cognitive errors. These types of errors are basic statistical errors, information processing errors, or memory capacities. They cause decision to deviate from rationality. In general, cognitive errors stem from faulty reasoning. It can often be, however, mitigated or eliminated through better information, education, and advice. Cognitive errors can be grouped into two types. First one, belief perseverance biases come from the result of mental discomfort. It occurs when new information conflicts with pre-existing belief or perceptions. To resolve this dissonance, people are likely to ignore conflicting information. They only consider information that confirms their existing beliefs and thoughts. The second type is information processing biases. Refer to information being processed and used in illogical and irrational manners. Below are some common belief perseverance biases and their corresponding behaviors in financial investment. So that you can see in this table, we have bias and consequences. First one, conservatism bias. So tend to hold on to past information. And the consequences, maintain existing views and predictions. Be slow to change even when market information has changed. Maintain existing views when facing difficulties in processing new and complicated information. The second one is confirmation bias. It tends to only notice that confirms previously belief, underestimates or ignores anything that contradicts it, and its consequences. Perhaps only consider positive information about the existing investment and ignore any negative information about it. When building a portfolio, investors may have been convinced of the value of certain company stock. They may have ignored the negative news, gathering only information that confirms the company is a good investment. They tend to give more weight and hold fewer diversified stocks, hold a high proportion of the shares of the working company. At the same time, only talk about the company's good news and ignores unfavorable information. The next bias is illusion of control bias. This one tends to believe one can control or influence outcomes when in reality they cannot. And its consequences is investors believe they can have control over investment outcomes, which may lead to excessive trading. Investors prefer to invest in companies they may feel they have control over. One example is the one they work for, especially in a high position. And now talk about the hindsight bias. So when the event has already happened, only one looks back and assumes that they already predicted it correctly. And its consequences is investors overestimate their ability to predict future investment results. For example, an investment has profits for unforeseen reasons. However, investors may rewrite their own memory to explain how they were able to predict this profit. It may be different from what actually happened. This happens because when people look back, they don't have a perfect recollection and tend to fill the gaps with what they want to believe. Tendency to rewrite the past can lead investors to take excessive risks. This may lead to the future fatal mistakes. Below are some common processing errors and their corresponding behaviors in financial investments. So the first bias is anchoring bias. It tends to rely on parts of original information to make further estimates, judgments, and decisions. And its consequences is investors may get too attached to the original estimate and make inadequate adjustment even when new information is updated. And next one is a mental accounting bias. It divides the money into different accounts mentally and affects the investment decision. And talk about its consequences. Investors divide the portfolio into several parts with different risk levels. Each part is designed for a specific purpose. This approach neglects opportunities to mitigate risk by combining assets with low correlations. Investors consider principal and profits as separate parts. They are willing to use the profit part to trade with higher risk. The next one is framing bias. This one answering a question differently depending on how it is framed or structured. And its consequence is focusing on short-term price movements. Ignore long-term consideration in the decision-making process. The last one is availability bias. This one estimating the probability of an outcome or phenomenon based on how easily information is obtained. And its consequences is choose an investment based on advertising and recommendation of many people. Ignore a thorough analysis of options. Invest in a company only because it suits personal preferences or because of familiarity. Ignore any risk and return evaluations. select stocks based on limited experience. Investors who are working in the real estate industry, for example, tend to allocate most of their portfolio weights to real estate stocks. Though having lots of relevant information and experience in their field, they fail to diversify and achieve an appropriate asset allocation. And the third part is emotional bias. Emotional bias arises spontaneously from feelings and attitudes. It can cause decision to deviate from rationality. It is typically harder to correct compared to cognitive errors because they originate from impulses and intuition rather than logical calculations. A person usually can only recognize and learn to adapt to it rather than correct itself. Below are some common emotional biases and their corresponding behaviors in financial investment. So the first one, as you can see on the table, bias, loss aversion bias. This one considering losses more serious than equivalent gains, and its consequences are find it difficult to accept stop loss, hold losing position unreasonably longer in the hope that the share price will return to break even. Sell winning investment too early for fear that profits will decrease. Next bias is overconfidence bias. This one is expressing an unfounded belief in one's own abilities. And talking about its consequences is underestimate risk and overestimate expected returns. Hold under-diversified portfolios that can lead to significant risks. And now it's about self-control bias. This one is unable to pursue long-term goals because of the lack of self-discipline. And consequences, investors have difficulties saving sufficiently for the future by sacrificing current consumption. When they realize this, they may take excessive risks to generate higher returns. Now, about status quo bias. This one is choosing to do nothing instead of making a change. An investor may unknowingly maintain portfolios with inappropriate risk characteristics and fail to explore other investment opportunities. Next one is endowment bias. This one is tending to value and assess more when they hold rights to it rather than what they do not. And its consequence is failing to sell off certain assets, thus maintain an asset allocation inconsistent with the investor risk tolerance and financial goals. This is especially true for inherited investments. When investors inherit a number of stocks, for example, they fail to sell off even when these stocks face a bad outlook due to emotional attachment. And the last one in emotional biases is regret aversion bias. This one is avoiding making decisions for fear the decision will turn out poorly. And its consequences is be too conservative in investment choices due to poor past results. And engage in hedging behaviors. Investors feel safer in popular investments. And now we're going to talk about the next part is application of behavioral finance in algorithmic hypothesis formation. The focus of behavioral finance is the study of behavioral biases that influence individual investor decisions. Behavioral finance doesn't show how to properly predict the future, nor does it provide a financial investment model that can confidently beat a market. However, behavioral finance still can help investors have deeper insights into how the market actually works. It helps build more reasonable algorithmic hypotheses. Price momentum is a common phenomenon in the stock market. It's an unusual movement of the stock price. It can be observed that when a stock rises or falls sharply in the short term, the trend tends to continue. In terms of behavioral finance, price momentum can be explained by availability bias, the tendency to forecast an outcome, or the importance of phenomenon based on how easily the information is recollected. When a stock price keeps rising, investors easily remember this event and unconsciously assume a future rise is more likely than a fall. Besides, hindsight bias causes illusion to investors who believe they could have forecasted a future rise and would regret it when it missing the buying opportunity. Investors are thus urged to overcome this regret by placing buy orders even when the stock market price is already high, much higher than its intrinsic value. Believing the biases above can have a strong market impact. Algorithmic traders can take advantage of the price momentum strategy to seek short-term profits. Behavior finance also explains the phenomenon of absurdly sharp rises in stock prices during a brief period of time. In addition to the price momentum inside both, buying and selling shortly after will still be profitable even if investors have sold too early. A few short-term profits bring a sense of pride and confirm the investor belief that they made the right investment. Hindsight bias can reinforce an investor's belief that their previous trading strategy was correct and will continue to be profitable in the future. Overconfidence bias gives an illusion of their forecastability. Conservatism bias makes investors ignore contradicting information or opinions. As a result, investors are still willing to open more long positions at high prices, even using margin to increase purchase power. It further causes increased demand and the stock price continues to rise rapidly. That, in context of absurdly rising stock prices, investors can apply the mean reversion strategy. They can open short positions when the security price already rises too quickly and expect it will revert back to the reasonable mean. So this is quite a long reading. I hope you can find some information. And if you want to rewrite, then just watch the video again. So that is the end of article 25. And I see you next time for the next chapter.